In this presentation, we'll go over the theoretical justification for the claim that an inverted yield curve is a signal for a recession, and we'll also go in and take a look at the data and see if the historical record bears this relationship out. Note this is the link to the presentation, and I'll put the link in the video description below in case you want to bring this up and follow the links and use the app and so forth. So first, before we jump into the presentation, we can take a look at the yield curve, and this is as of 9/23, and we see this is an inversion in the yield curve. So the idea here is these are all annualized yields, and the 1 month Treasury bill is yielding more than the 5-year Treasury note. So this is what we mean when we say there's an inverted yield curve. Note here that the yield curve is not inverted past 5 years at this point. So the idea is we have an upward sloping yield curve, so we can have an inversion in the yield curve over just a portion, or we can have an inversion over the entire yield curve, which is, well, where we're generally tending to get the 1 month here is 2.06 and the 30 year is 1.95. So what we're going to talk about today is this: what does this mean when we have an inversion in the yield curve? So jumping into the presentation, note that the theoretical justification of this is going to be based on a theory of the term structure of interest rates. The term structure of interest rates is different, slightly different than the yield curve, but we won't get into that here. But there's a pure expectations theory of the term structure, and this presentation here dives into that. So if you want a more detailed explanation of pure expectations, you can look at that presentation. Here we're just going to talk about the result. So the basic idea of pure expectations is that long-term interest rates are an average of the short-term interest rates. So the idea here is the yield on a 10-year Treasury note, right, is just the average of the yield. So we know the yield on a 1-year note today, so it's the average of the yield on the 1-year note and the expected yields on the 1-year notes for the next 9 years, right? So the idea of this is that pure expectations is going to give us, given a 1-year rate and a 10-year rate, it's going to give us what the expected 1-year rates will be over the next 9 years. And this is not anything particular with 1-year rates. So the idea is if we have a 10-year rate again, and then we have a 5-year rate, so we have a rate on a 10-year note, the rate on a 5-year note, then by pure expectations, we can get the expected 5-year note rate in 5 years. So running through some actual numbers, if we expect the 10-year to yield 5%, and today's 5-year rate is 2%, so this is not an inverted yield curve, then the expected, again, this is where, this is the important thing, the expected 5-year rate in 5 years is 8%. So what this means is, well, the 5-year rate is 2% today. The market expects the 5-year rate to be 8% in 5 years. So this is consistent with economic expansion, right? So this is not an inverted yield curve. This is an upward sloping yield curve, and it's indicative of higher rates in the future, which we tend to get if the economy is growing, right? However, if the 10-year rate today is 5%, and today's 5-year rate is 7%, so this would be an inverted yield curve. Then what this is saying by pure expectations is that the expected 5-year rate in 5 years is 3%. So what this is, the idea here is the 5-year rate today is 7%, and we expect the 5-year rate in 5 years to be 3%. So the 5-year rate will decline in the future, and this is consistent with slowing economic growth. So we expect the economy to slow here. We expect future interest rates to decline. So pure expectations gives us this forecast of future interest rates, and what they're telling us in this case, in the inverted yield curve case, circle's too big, is that those future interest rates will decline, which is consistent with a recession. So when we get the yield curve is inverted, this generally tends to mean slowing economic growth because the future rates are expected to be lower. So, on this slide, I wrote a little JavaScript here, and you can run through some of these rates and say, okay, well, if the 10-year rate is, 9% and the 5-year rate is 7%, then we expect the 5-year rate in 5 years to be 11%. So this would be not an inverted yield curve. This is economic expansion. But if this were 10%, then we would expect the 5-year rate to decline in the future, which is consistent with recession. So you can, enter different 10-year rates and 5-year rates and see the expected 5-year rate in 5 years. This should say, these are the rates we observe today, and this is the expected 5-year rate in 5 years. So, it says 5-year rate in 5 years. I should put expected here. So feel free to use that, but this will allow you to look at what the market expectations of future interest rates are. What I should say is, if you look at there's other additional explanations of the term structure of interest rates and the liquidity premium theory, and if you add in these other if you add in the liquidity premium to this, the indicator of recession would be even more pronounced. So the idea here is, if we add in a liquidity premium, the expected rate would be even lower in the future. So this is the base case. So that gives us a good theoretical grounding in why we should expect a recession. In summary, if the yield curve is inverted, this means the market expects lower interest rates in the future, and lower interest rates in the future are consistent with recession. So this gives us a strong theoretical justification, but do we see it actually in the data? So the nice thing about finance here is we can always look back and say, okay, well, what actually happened? So what we have here is the term structure. This is the yield curve. So what we have is the federal funds rate out to the 20 or 30 year. Right here we have the 30 year, and these, in periods where what you can see is the yield curve inverting looks like where the yield curve compresses here, right? So here we have this is not an inverted yield curve. Federal funds rate 1%. Out to the 20 year is 5%. However, here it compresses to, now we have an inverted yield curve. And in pink here are recessions. So these are recessions, official recessions from the NBER. So generally what we tend to see is, the yield curve inverts and then there's a recession thereafter. The yield curve inverts and there's a recession thereafter. This is the 2008 financial crisis. This was the 2000, tech bubble here. Again, going back to the 91 recession, inverted yield curve, we tend to get a recession afterwards. So broadly speaking, we do, this is anecdotal evidence. This is not a proper statistical test, but anecdotally, we generally tend to see an inverted yield curve followed by a recession. This relationship has a strong theoretical justification, and we do tend to see it in the data. Again, it is all told a decent indicator. This presentation is the code for it is on GitHub. So if you ever want to see the code underlying this presentation, feel free to check it out. Also, if you ever want to add anything to any of these presentations, feel free to issue a pull request. Otherwise, have a great day.